back. You're watching The Money Show, and let's get your portfolio queries answered. I have with me Pankaj Mathpal, who's the MD of Optima Money Managers. Pankaj, good evening and welcome to the show. Pankaj, today we'll take Raghu's question first. This question is via email. He says that how can he shift his PPF amount to a balance advantage fund? I mean, that's the option he's exploring, and would also like to withdraw 5% after 1 year by way of SWP. I don't have him on the phone line because we would have given the strategies, by giving an entire financial plan or a strategy for his investment. But okay, PPF amount or PPF investment is a fixed income investment, and he wants to put that money to a balance advantage fund, which will have an equity exposure to it also. You can start by helping Raghu understand the two different type of investment options that he's considering. A PPF, which is totally a fixed income, and balance advantage that comes with a mix of two asset classes.
Kavita, good evening. See, as you said, that when we talk about PPF, it gives you guaranteed returns. The returns are not very attractive, but these are tax-free. And from time to time, government may review and reset the rates. And at present, it is 7.10%. But if you compare with hybrid funds, as Raghu has mentioned, multi-balance advantage fund, in long term, you can expect returns from these kind of funds little better than PPF. But in short term, these funds can be volatile because we know they invest in equity and debt, and equity has its nature, means volatility is the nature of equity. So if he wants to switch, he can do it for long term. But as you mentioned, after 1 year, he wants to withdraw. My suggestion at this moment, if he plans for next 2 years instead of 1 year, his cash flow through some other instruments, he can keep the money in fixed deposit for next 2 years. And after that, instead of 1 year, he can start SWP after 2 years, and then he can continue. So expecting 0.5% every month is the, I think, fair expectation. So he can do it, but only suggestion that instead of 1 year, he should take 2 years time to start his SWP. And some funds I can recommend here, like ICICI Prudential Balance Advantage Fund, HDFC Balance Advantage Fund, Mahindra Manulife Balance Advantage Fund. These funds can be considered.
That's the explanation for you, Raghu. But then if in case you want to add something more to your question, you can send across your question and also be on the phone line this time. Pankaj, let's move on. Let's take Kalyan's question now. And he says that he's 40 years old and he wants to start investing in mutual funds for next 10 to 15 years. And he's looking at doing an SIP of 30,000, and the aim is to achieve 2 to 3 crores within 10 to 15 years. So he will also step up his SIP. That is what he's saying. I'm not sure about a specific goal that he might have tied to this particular corpus, but could be a retirement goal. I mean, if we take it as a retirement goal, what do you have to say?
Considering 15 years investment horizon, if I assume 12% CAGR, and as he mentioned, 10% step up, he can do in his investment. So with 30,000 rupees per month starting from now with 10% step up, he can expect around 2.48 crores in 15 years. But though we know that markets are volatile, but you are investing through SIP route, you should have allocation across large cap, mid cap, small cap. And for this, diversified funds will be a good choice. So like Bajaj Finserv Flexi Cap Fund, Motilal Oswal Large and Mid Cap Fund, and Kotak Multi Cap Fund, each fund can be considered for long term.
All right, so that's a response for Kalyan's question and the fund selection also that you've recommended. Bajaj Finserv Flexi Cap, Motilal Oswal Large and Mid Cap, and Kotak Multi Cap. Let's move on. Let's take Dilip Kumar's question, Pankaj, and he's investing in Quant Mutual Fund, Quant Focused and Quant Flexi Cap. 50,000 lump sum each. Now, he wants to know whether he should be holding on to these funds or he should be making an exit, and what is the future for these kind of funds. Very interesting question, and I think a lot of investors who've lately been, impressed by... Quant mutual funds, performance, especially in small cap and other categories, might want to know the future of their funds now, fund performance. Now, looking at a specific type of strategy that Quant follows, what would you recommend to Dilip? We don't have his entire portfolio to understand the kind of diversification he has, so we have no idea what's the exposure within the portfolio and within the funds that he has given to these investments. What will you advise?
Kavita, Quant as a fund house, they follow momentum strategy. So when there was a rally in the market, we saw that funds were performing very well, outperforming the broader market. But now, because in volatile market, we have experienced that funds are not able to perform as expected. So investors definitely are a little worried and asking this kind of question. Answer to Dilip as well as to other investors. See, if you have a small allocation of your total portfolio in quant funds, then you can stay invested, because as you mentioned that you have investment in quant flexi cap fund, which has flexibility to invest across market segments. So as a category, flexi cap is a good choice for long term. Definitely you can stay invested, but because we are talking about quant flexi cap fund, and one thing, it follows a momentum strategy mostly. Second thing, approach is more focused, so number of stocks are limited in the portfolio. So considering this fact, I'll say if you have a small allocation in this fund, you can stay invested. Otherwise, you can move to some other flexi cap funds like HDFC flexi cap, Nippon India flexi cap, this kind of funds.
I think with that, it's a wrap of our question answer session today. Thank you so much, Pankaj, for taking your time out and answering all the portfolio queries.
If you like this video, then like, share and subscribe to ET Now.